Investing in privately held startups and growing companies has historically been open to wealthy Americans. That was because investors in these opportunities needed to fit within the Securities and Exchange Commission's narrow definition of an accredited investor, which less than 2% of Americans do. While being left out of these often lucrative investment opportunities, most Americans could turn only to real estate, publicly traded stocks, treasury bonds, and the like. But an onslaught of Wall Street scandals, the infamous mortgage industry collapse, and the Great Recession have made those types of investments far less appealing. Because of the Invest Georgia Exemption and a federal law called the Jobs Act, investing in privately held startup and growing companies has been open to just about every American instead of just the super rich. As you've probably heard, investing in businesses during their earliest stages can prove to be extremely profitable. $500 invested in Google when it first started in 1998 would be worth $10 million today. A more recent example is social media site Tumblr, which was purchased by Yahoo for $1.1 billion, and a $500 investment in Tumblr when it first started would be worth about $750,000 today. Hundreds of less well-known companies are bought every year, providing great returns to their earliest investors. Venture capitalists have made billions of dollars with early-stage investments. Equity and debt crowdfunding finally opened these types of investments to just about all Americans, giving Americans the same opportunities the super rich have enjoyed for decades. Of course, investing in startup and early-stage companies is also risky. A high percentage of young companies fail or never reach profitability, and in those cases, investors can lose their entire investment. If you do not understand or cannot tolerate these risks, you should stay on the sideline until you are ready. A final note: you can learn a lot from the investment model of venture capitalists. Venture capitalists do not invest their entire fund in a single opportunity, but rather spread their funds out among several opportunities. They do this with the expectation that one or two big successes will make up for the failures, plus provide a nice profit. You should consider whether a similar strategy of spreading your investment funds out instead of putting all into one single opportunity is right for you. It just might be. Thank you for joining us.